Hey everyone, welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. I am so glad you're joining us today. In this explainer, we are going to conduct a suo moto review of a real published financial statement from a listed company. We're going to pull apart the numbers, diagnose the core issues, and see exactly what went wrong. Okay, let's dive right into this. Now, before we open up the patient's file, let's just establish a few quick ground rules for our clinic today. Please keep in mind that the views expressed here are the personal views of the author, CA Manish, CIR, and they aren't binding on anyone. We always strongly request that you seek the help of an expert before taking any action or holding back from any action based on what we discussed today. Also, just so we are all on the same page, our functional and presentation currency is the Indian rupee. So any currency that isn't the Indian rupee is considered foreign currency. And finally, our reporting period for this case begins on the 1st of April and ends on the 31st of March. Okay, here is our roadmap for today. We'll start with Section 1, the symptom. Then we'll move into the diagnosis, look for some missing links, deliver our prognosis, and finally, wrap things up with the prescription. All right, let's jump straight into Section 1, the symptom, the observation. So we've got the patient's file open. This observation actually comes directly from the published Ind AS financial statements of a listed company, which was independently downloaded and reviewed by us at Gap Advisors on a suo moto basis. Now, what's really fascinating here is right under the investments heading. Take a really close look at the preference shares. You'll notice the company has quite unusually split their investment in these preference shares into two distinct pieces, an equity component and a debt component. Keep that little detail in your back pocket because it completely sets the stage for our diagnosis. And bam, here is the critical symptom that immediately sets off the alarm bells. Look at the measurement columns. Both the split equity component and the debt component are being categorized and measured at amortized cost. I mean, splitting an asset is one thing, but measuring an equity component at amortized cost, that is a massive red flag. We definitely need to investigate what's going on here. Which brings us right to Section 2, the diagnosis, evaluating Ind AS 109. So let's pull out the rulebook. The standard gives us absolute clarity on this. IAS 109, specifically paragraph 4.3.2, explicitly states that if a hybrid contract contains a host that is an asset within the scope of the standard, an entity shall apply the requirements to the entire hybrid contract. So the bottom line is, because this instrument is a financial asset for the company, it simply can't be split. You don't just get to slice and dice it into equity and debt pieces because you feel like it. The entire hybrid contract has to be evaluated as one single asset. But, let's play devil's advocate and look past that improper split for a second to examine their chosen measurement, amortized cost. Under paragraph 4.1.2 of Ind AS 109, you can only measure a financial asset at amortized cost if you meet two absolutely mandatory conditions. First, the asset has to be held within a business model whose objective is just to collect contractual cash flows. Second, it has to pass the SPPI test, meaning the contractual terms give rise on specified dates to cash flows that are solely payments of principal and interest. And this is where the wheels completely fall off. By its very nature, the contractual terms of an equity component do not give rise to cash flows that are solely payments of principal and interest. It fails the SPPI test right out of the gate. Plus, if you just look at the company's numbers, the value of that equity component is sitting there, totally static, at 855.61 crore rupees year over year. Think about it. If they were truly measuring this at amortized cost, you would see cumulative amortization using the effective interest method. A flat, static value proves they aren't even accruing effective interest properly. It is just a total failure to comply with Ind AS 109. Moving on to Section 3, missing links, disclosures, and cross-referencing. So if we look at this detailed breakdown of the preference shares in their subsidiaries, we hit another glaring omission. When an entity has a day one difference, that gap between the fair value on initial measurement and the actual transaction price, paragraph 28 of Ind AS 107 requires some very specific disclosures. This includes showing the aggregate difference yet to be recognized in profit or loss. But guess what? The company has completely missed disclosing these details in the investments note or the financial instruments categories note. Just totally missing. Now, you might be thinking, hey, maybe those disclosures are just hiding in some other note. Well, if they are, they're practically invisible. Paragraph 113 of Ind AS 1 makes it a hard rule that an entity must cross-reference each item in the balance sheet to any related information in the notes. Without this mandatory cross-referencing, which, by the way, is also required by Division 2 of Schedule 3 to the Companies Act, it is literally impossible for a user to track down where these critical day one difference disclosures might be hiding. All right, Section 4, the prognosis, final verdict. Have you guys ever dealt with the concept of obscuring information under paragraph 7 of Ind AS 1? Basically, information is obscured if it's communicated in a way that has a similar effect to simply omitting or misstating it altogether. A prime example of this is scattering material information all throughout the financial statements without clear cross-references. By dropping the ball on cross-referencing the required Ind AS 107 disclosures, this company has essentially scattered their material data, which directly violates the principle of clear and transparent presentation. So let's stack it up and contrast what should have happened with what actually happened. Compliant reporting requires evaluating the entire hybrid contract as one single asset, actually applying the SPPI test properly, and making clear cross-reference day one disclosures. What we actually got in this specific case was an improperly split asset, a failed SPPI test wearing an amortized cost trench coat, and entirely obscured, unreferenced information. The prognosis? A pretty severe case of noncompliance. Finally, Section 5. The prescription. Gap Advisors Resources. First off, if you want to ensure your own financial statements don't suffer from these kinds of ailments, I highly encourage you to visit gapadvisors.com. The site hosts an incredible issue repository with over 4,500 issues and detailed responses on Indian accounting standards and Indian GAAP. And the best part? Any person can register for free. You just submit your issues on Ind AS and Indian GAAP, and you'll get a detailed response delivered directly to the inbox of your registered email. This is an absolute lifesaver, particularly for auditors who really need to document exactly how they addressed any issue relating to the application of Ind AS. Secondly, a pro tip. Don't wait until the ink is dry. Get your financial statements reviewed by Gap Advisors before signing them. You can just submit your financial statements in a near-to-publishing PDF format by email straight to info@gapadvisors.com. I should also mention that the brilliant observation we just walked through was actually featured in the 226th edition of the Gap Advisors Task Weekly newsletter authored by CA Manish C. Iyer, Director of Gap Advisors, and published on LinkedIn. To date, over 230 editions of the weekly newsletter have been published. So if you're registered on LinkedIn, you absolutely must go subscribe to the newsletter for free. All right, do you want to nerd out and dive even deeper into the nuances of the observation we dealt with in this explainer? Then you should definitely connect to the Gap Advisors Ind AS Clinic podcast, which is available right now on Spotify, Amazon, or YouTube for a really thorough deep dive. Thank you so much for your time today. If you found this valuable, please hit that like button, drop your comments, and make sure to subscribe to the Gap Advisors Ind AS Clinic channel if you aren't already. And please share this explainer among your contacts, your colleagues, and your audit and finance teams to help spread the knowledge of Indian accounting standards. So before you sign off today, ask yourself, are your financial statements telling the clear truth, or are vital details just hiding obscured in the fine print? Stay compliant, keep learning, and we'll see you next time.